Hi, this is Charles Weeks with the Barrister Brief. Today I want to discuss two topics. The first one is international diversification, and the second one is about a recent article I read in the Wall Street Journal regarding pig butchery. It's probably not what you think, so we'll cover that in a second. But first, I want to cover international diversification. So, for about the last 14 years, U.S. equities have outperformed international equities. Now, there's been cycles of outperformance by the U.S. over international equities. They typically last less than a decade. This one has lasted for pretty good length of time. And I want to discuss why we're still investing in international equities. Ritholtz Wealth Management, a registered investment advisor up in New York, put out some really interesting stats that I thought would be worthwhile to share regarding how different countries performed over different decades. And I really think it drives home the point of why it's so important to stay diversified. It would be easy now, after 14 years of U.S. outperformance, to say, you know what, now's the time. We just need to go all in on the U.S. and stay there, which probably is like the absolute worst time that we'd be doing that. But just to give you some statistics, so in the 1970s, the top country over that decade was actually Japan. And the cumulative return over that decade was almost 400% for that particular country. The US was near the bottom at less than 100%. So, again, if you would have just invested in just the US in the 1970s, you would have underperformed. In the 80s, it was Sweden. And over that time, it was almost a 1,300% return over the 1980s, over that decade. Now, a lot of people would think Ronald Reagan, the 80s, our fight against inflation and rates starting to drop, that the U.S. would have been the best and would have been the outperformer, but it actually wasn't. The U.S. did about 400% over that decade. Still a good return, but not nearly as much as what Sweden did. In the 90s, it was Sweden again, at almost a 400, a little above a 450% return. The U.S. did well as well. They were over 400%, but not as good as Sweden. And Japan was actually the worst in that year. It was down 7%. So again, if you're trying to pick a country and guess what country is going to do the best over the next decade, and going into the 90s, you pick Japan, you would have done really poorly, especially from a relative standpoint to how the Sweden and the U.S. did. In the 2000s, it was Canada and Spain near the top, and the U.S. was actually near the bottom, again with Japan again. U.S. was down 9% over that decade. So from 2000 to 2010, if you would have only invested in U.S. equities, you would have lost 10%, almost 10% of your money. Whereas if you would have stayed diversified in a diversified portfolio across many countries, you would have had a positive performance. Now, the last 20 some years, the U.S. has been at the top. So during the 2010s, it was over 25% over that decade. Spain was at the bottom with a negative 5% return. And then in the 2020s, the U.S. was up almost 70% over the decade, with Germany at the bottom, up 19%. So every country did great in the 2020s. The U.S. just outperformed. So it's really been the past 2 decades that the United States outperformed. Prior to that, it was other countries that were outperforming. And we always, in this industry, always talk, about past performance and how it's not indicative of future results. And it's really hard to act on that in the moment, but it's really important to just stay diversified, stay the course, keep a basket of U.S. and international equities, emerging market equities, frontier market equities, just so that, when inevitably we have this cycle end and international stocks outperform, we still have some exposure there. So the second topic I want to discuss is this article I read in the Wall Street Journal not too long ago. It's been going on for the past couple of years, but it's starting to change a little bit, where it started with text messaging. It's now moving into social media. Specifically, this article discussed LinkedIn, and this financial fraud is called pig butchering. And it's focusing more on seniors at this time as well. And that's what this article talked about. So this gentleman was contacted on LinkedIn, 75 years old, contacted by, what he, thought was a woman, may or may not have been. Apparently in China, there's literally operations, uh, uh, you know, organized operations for pig butchering, where they'll put people in a call center, they'll put them in front of a computer, and they'll just constantly throughout the day reach out to victims and try to find people to defraud money of. So this gentleman was 75, was contacted, thought he was talking to a woman. The woman quickly moved him, or whoever it was that he was interacting with, moved him off of LinkedIn onto WhatsApp, a texting chain, then introduced him to a trading app that he downloaded, and convinced him that her uncle was this currency trader and that they were going to become millionaires on this app. And he slowly, over time, took all of his money and put it on this app, and thought he was trading, and thought he was, going to build wealth with this person. And at some point, it became obvious. So now this gentleman also was warned by his bank that this was likely a scam and he should not be sending money to this app. And despite all that, and despite what would seem obvious to people reading the article that it was a scam, he still fell for it. So put all of his net worth into this app, 750,000 plus, and they call it pig butchering because they don't just stop at whatever fraud whatever amount of money they've gotten from you. They really go for the kill. And the kill is that once he realized that this might be an issue and he was trying to get his money back, he got a message from the app saying, if you want your money back, you need to pay $200,000. You need to, I think it may have started at 50,000, then went to 200. So now not only has he liquidated all of his retirement accounts, all of his savings accounts, everything else, now he's starting to tap into home equity. He's starting to try to borrow money from people to try to get this money back. Meanwhile, of course, he's not going to get any of the money back. They're literally just trying to bleed him dry. So I think it's really important to be aware of these scams, be aware that they're out there. Banks will try to help you. If you ever ask me to wire money for you and you tell me it's for an international currency trading app, I'm really going to fight you for it and tell you it's probably a bad idea. But it's important that you're aware of these scams for not just yourself, but your family members. I always tell everyone, be careful, what you click on. The financial cybercrime area is just getting more and more sophisticated all the time. So it's really something that we have to be aware of and we have to watch out for. So as always, if you find this helpful, please share it with your friends and family. If you want to learn a little bit more about Barrister, if you're not already working with us, you can view our website at www.barrister.net. As always, enjoy sharing this information with you, and have a great day. Take care.